Hey, good evening, everybody. You're welcome to our online class. Sorry for starting a bit late or behind schedule. I was trying to fix some technical glitches here. I do hope we had a great day. Please, if you can hear me, you can indicate in the chat room so that we can start. So just help me to indicate if you can hear me from in the chat room. Okay. Great. All right. Good to be here this evening. Uh, I wanted to say good to see you, but obviously I can't see you, but you can see me from wherever you are. All right, thanks for joining. Once again, I apologize for starting a bit behind schedule. Okay, so it's about 6 minutes past 8 by my time, so we need to get going. So we have an interesting session this evening. So before we start, let me recap on what we did the last time. So before we go straight up to what I have for you is talk for this evening. By the way, I just dropped the material on the platform so you can, take a look at that. So that's the material we are going to be using this evening. Um, okay, I have a comment. I'm happy to see your face today. The class feels more real, physical when we see your face. Oh, great. Okay. I'm happy to see you too in spirit. All right, you're welcome. I hope the network will be favorable this evening, but notwithstanding, if probably I had or I'm going to have a network glitches from here, just rest assured that I'll make effort to come back online, okay? And but I hope it's going to be smooth this evening. So the weather is looking good, and we're going to land having good weather, even though we are not flying. Okay, now the last time we started discussion on financial analysis, you remember? And of course, I told you to say that when you look at financial analysis, it is divided into two. You have financial statement analysis, and of course, financial data analysis. So I mentioned to say, if you need to carry out financial statement analysis, you need 5 documents, okay? So one of them is income statement, otherwise known as the statement of profit or loss account and other comprehensive income. You also need statement of financial position, note the account. We also looked at or talked about cash flow statement and of course, statement of changes in equity. Okay, so I remember telling you to say what I've seen in ICANN exam so far when it comes to case study is 4 of them, maximum of 4, but 2 of them are the most regular or that you require, to carry out financial statement analysis, and that's the income statement and the statement of financial position. So once you have those 2, you are good to go, okay? And from there, I also mentioned to say any other financial information outside those 4 documents will be regarded as financial data analysis. And that word is very wide in the sense that the examiner can, go into any area, around your SFM, your performance management, around contribution analysis, net present value, payback period, even internal rate of return, product mix, cost, volume, profit, okay? But what was common since 2019 has always been net present value, that's NPV, and contribution analysis, okay? And I also mentioned to say, when we see the person, most likely we'll have an insight into what our financial data analysis, which we contribute or which we constitute our requirement to, is going to look like. Okay. So from there, we checked analytical tools around financial statement analysis. Okay, so we said we had 4 analytical tools, at least as far as case study is concerned. So you have a trend analysis, you have common size analysis, you have ratio analysis, and of course, working capital management, or otherwise known as cash operating cycle. Okay. And again, I told you how to carefully select, which of those analytical tools will be required when it comes to financial performance analysis. Okay. And we said common for trend analysis, also known as horizontal analysis. You're going to apply a formula that is new year minus old year divided by old year multiplied by 100%. You can remember. And I said you are going to apply that, especially when you're looking at revenue trend. For example, you might also decide to do any other item in the income statement. And I said probably you should not do more than 5 or 6 items just to save time. And if the examiner wants you to analyze revenue trend, costs, and overhead trend, for example, so you can decide to do the trend for all those key items in the account. Okay, right. So should be conversant with how to carry out that. Okay, and of course, we also discussed common size analysis, also known as vertical analysis. So here, you're going to apply a formula, item of interest over referenced item, okay? So reference item for your income statement is your revenue, and reference item for your SFP, statement of financial position, is total assets, okay? So item of interest, any item that interests you in the income statement, you place it over revenue so that you can look at the proportion of those items against revenue. So that's what they call it vertical analysis. So it's looking at just a year, okay? Trend is looking at year in, year out. But remember I mentioned to say you don't need to do trend analysis for your SFP, okay? That's your balance sheet, statement of financial position. Don't bother yourself. You're going to waste time, okay? So just do maybe 5, 6 items. If you have more than those 7, maybe if you have more than 7 items or 8 in the income statement. But if you are a very fast person, obviously you can decide to do for all the items in the income statement. But if you are not that fast, I will indulge you to say just select revenue, cost of sales, gross profits, then any other major item, maybe 2 or 3, and you quickly do that. Okay. So again, but you need to have knowledge of all of this in case you have to do this in practice. So that's why I'm taking you, to have an idea of how it actually works. So if you want to look at vertical analysis, so you look at, for example, cost of sales over revenue, gross profit over revenue. You can look at administrative expenses over revenue. So you're checking to look at the proportion of those items against your revenue. So it also helps in decision making so that you actually see whether your costs are climbing to, to consume your revenue, or probably they are under control. Okay. And of course, it also depends on the industry and the key metrics or key performance metrics that might have been set by the company. For example, if you look at your cost of sales over revenue, you can have maybe 55%. That means your cost of sales is 55% of your revenue. So in some industry, it could be good performance, and in some other industry, it may not be good, because what that implies is your revenue is even more than half or more than 50% of your revenue. So it helps you to look at where or areas where you actually have to improve on. And from there, we check, and I told you to say you may not bother about common size, right? Because you have some of those items, usually 2 of them, already in your ratio analysis. Or you can just decide to lump it under your ratio analysis instead of separating them, in your appendices, okay? So because already you have gross profit margin and net profits, which technically they are also common size analysis, because you are looking at your gross profits against your revenue, and the same applies to your net profit margin. Okay, so, and again, the same thing with working capital management, also known as cash operating cycle. There are 3 of them: inventory days, receivable days, and payable days. Okay, so those 3, if you isolate them, We can look at cash management efficiency of a company, looking at those three items in terms of short-term solvency. Okay, but then that will also form part of your ratios. So that's why we are not calling it out. Obviously, you have a lot of points you can make, within those three items alone. And I think I shared some insights in the last class, okay, if you can remember. Okay, so but for our ratios, which is going to be the main focal points, for your case study analysis. So we have 10 of them that I recommended that you should start learning, and that will help you, to really prepare, because what the examiner wanted, so is a twist. If you are writing corporate reporting, for example, obviously you're going to do ratio analysis, although I like to call it performance analysis if I were to be the one that would take you corporate reporting, for example. Because when you look at performance analysis or performance measurements, they are divided into two. You have financial performance and non-financial performance. So under the financial performance, you still have all these analytical tools. So, but again, what I want to point out is this. Sorry. So if you're writing corporate reporting and for your ratio analysis, okay, somebody saying my voice is low. Is that correct? I think I'm shouting at the top of my voice. You can look at your device. I'll probably increase the volume. My system is actually very high, and I'm trying to speak louder. Maybe you can look at your device anyway. And some people is saying it's loud and clear. Oh, okay. Yeah, I have a couple of people saying it is loud and clear. It's loud and clear. Should I use my earpiece? Maybe it will be better. Let me try that. Because I'm really shouting anyway. Um, I'm on my device. Oh, sorry, on my earpiece. I'm not sure whether this is better. Okay. So you can confirm if this is better, then I can continue with this. Or if it is worse, then I can remove it. Okay. I think it's better, right? All right, so let me continue my story. I was already performing in the spirit. So before I saw that comments. So let me see if I can pick it up from where I stopped. Okay. Where did I stop? All right. Yeah. So I wanted to tell you something, right? Around corporate reporting. You might have written corporate reporting before, that's no problem. But I know a couple of you guys are writing corporate reporting this time. So there is a twist, right? In corporate reporting or financial reporting, if you are doing ratio analysis, the examiner is more concerned about the accuracy of your figures. So what does that mean? If you are computing those ratios, your gross profit margin, your return on capital employed, your asset turnover, or whatever he has asked you to do, is more interested in the accuracy of the figures. What that means is you must get those figures correctly. That is in corporate reporting. He ascribed higher marks to those computation. Then he awards lower marks to interpretation. Okay, incorporates a twist. Okay, it is a twist. We'll come to play. Okay, now in study, yeah, a treasure where you were supposed to say 15%, and you said 10% or 14% instead of 15% or 13%. But if you are able to interpret it correctly, it's going to give you, it's going to award mark for you. Okay? So it's more interested in your interpretation in this paper. So that's why I told you to say, if you like, do 25 ratios. Okay? Do 25 ratios. You cannot get more than the maximum marks he has awarded, for that particular computation. So what am I saying in essence? You have to be prepared to write reports, okay? And you have to be prepared to carry out a fantastic analysis, okay, in that regard. So this is very important, and you need to understand that, okay? Please take note of that. Okay, sorry, I'm seeing some comments around poor network, sorry. Okay, now, what do I have for you today? We wanted to check, I want to demonstrate how to carry out financial analysis. So that's what I wanted to demonstrate this evening. So I needed you to listen, okay? Now, remember we already agreed on the, what's it called, 10 ratios that we are supposed to do. Can you remember then? We talked about profitability ratios, and I said you should choose 3 of them. That's your gross profit margin, net profit margin, and return on capital employed. I also remember giving you a code or a formula to remember the formulas for those ratios. And the code is what is on the left over what is on the right. Somebody help us to shorten it by saying left, right, and stuff like that. So it's easier for you to remember those formulas. But obviously, if you have done a lot of practice, it will be part of you, okay? But in case you don't have that luxury of time, so that is why it is important you can just, master that code, then you are going to remember. So we have 3 under profitability ratios. Then under current ratios, we have 2 of them. We have current ratio, that's under liquidity ratios. We have current ratios and asset test ratios, making 5. Then under short-term solvency and stability ratios, we have another 3, your inventory days, receivable days, and payable days. And under long-term solvency, that we naturally measure the ability of a company to meet its long-term financial obligation. So we have 2 under that. We have leverage ratio, otherwise known as gearing ratio, which is your debt over equity plus debt multiplied by 100%. Then you also have debt to equity ratio, and if you like, can do interest cover. Okay, so these are 10 or 11 of them that you need to start mastering. Yeah, but remember, I also told you that instead of the examiner going through the route of general ratios, which I just listed, they can decide to look into industry-specific ratios. But I can't determine that now until we see the preceding first week in May. Okay, so it's going to be released exactly 2 weeks to case study exams. So you remember, you have to expect that in the first week of May, maybe around Thursday, thereabout. When I look at the calendar, I'll know the dates. But sometimes they can release it the day before that Thursday. Okay. So when I see maybe the case scenario, so I may be able to determine whether it's going to come up around industry specific ratio. But at the moment, we need to start learning all those ratios. So it's going to really help us. I also mentioned to you that it can also test any of the accounting standards. So it has been on and off around accounting standards. So you don't need to worry yourself about accounting standard for now. Okay. So when we see the person as well, we'll know which of these or those accounting standards might be relevant. Okay. So what am I doing today? Somebody saying no sound. Please confirm you can hear me before I continue. Somebody should just confirm, please. I know I have a brand new system, so it shouldn't be having a sound issue. Okay. All right. Thank you for the confirmation. If I ask one person, a lot of people we respond. I love that. Thank you so very much. Okay. Now, be with me here. In the last class, I did not talk about this. So I want to talk about it now before we look into this question before us. So please be with me. And somebody can also help us to put it on the charts and on the group so that we can highlight it. Okay? How do you interpret ratios? Be with me here. When you are writing your report, how do you interpret this ratio? Because it has always been a problem or a challenge for most ICANN candidates that how do we even write the report? How do we interpret in the report? Okay, so that is, I want to give you a formula, or I want to give you, what will I call it now? I want to give you some information, that you need to consider when you are carrying out those interpretation of financial ratio that will eventually form your reporting. And I will not just tell you alone, I will also apply it. So that's exactly what we are doing in the next couple of minutes. Okay. All right. In the next couple of minutes. So be with me. If you have your pen, and your paper, you can write it down. The other material that you have, that's section 2. Okay, is there. But you have it already. So, but I didn't want to rush last week. That's why I didn't talk about it. So I said, let me discuss that because we're still battling with all those 10 ratios that we needed to start calculating. So how do you interpret financial ratios? And I will tell you how the examiner marks it. I will tell you so that it helps you to know where to channel your energy. So I need you to listen. So this is financial analysis part 2. Okay, we did part 1 last weekend. So this is part 2. Next week, we'll start reviewing case study. ICANN case study pass exams, real life, or the original one. So you're going to see. But today I have an appetizer for you. So I just have a small case so that I can show you how to carry out great financial analysis. Okay. What I wanted to tell you now, if you sign up for any advanced financial analysis class, it's the same thing they're going to tell you. But sometimes people will go and pay 500,000 for one class, 1 million naira for one class, for advanced financial analysis class. Why? Because they are doing it under one big name. For example, maybe London Business School of Finance or Lagos Business School or something like that. But me, small me like this, how many people knows me? But it's the same thing they are going to tell you. Okay. Number one, you are going to talk about what has happened. Okay. So that's number one. What has happened? Okay. Now, if you look at revenue trend, you have calculated revenue trend. So when you are interpreting, you're going to discuss what has happened. My revenue, are you increasing or are you declining? That is it. What has happened? Decrease or increase? Okay. Every candidate can do that. Let me tell you why. Now, because that one is very straightforward. For example, you can say the review shows that revenue increased by 10% between 2020 and 2021. Full stop. Revenue also witnessed another increase of 25% between 2021 and 2022. What you are telling is what has happened. That's what you are saying. Okay. Or if it has declined, you also say the same thing. The review shows that revenue declined by 9% between 2022 and 2023. It further witnessed another decline of, let's say, 15% between 2023 and 2024. That is what you are saying. What has happened? Is it increasing or declining? The same thing if you have computed your gross profit margin. Is it increasing or declining? The same thing with net profit. The same thing with current ratios, asset test ratios. Which other one? Inventory days, receivable days. What has happened? So that's the first thing you are saying. when you want to start your interpretation, you are going to discuss what has happened. So most times, what you see is either increasing or declining or decreasing. That's what you normally see. But there are other two that may happen. But I've not seen ICANN disturbing candidates around that. And that is static. Okay. Sometimes your revenue can be static. That means there is no significant increase, or there is no even marginal increase year in, year out. For example, in year one, your revenue was 500 million. In year two, it was around 499 million. In year three, another 500 million. In year four, another maybe 501 million. Okay. So you can say revenue was relatively stable. It was static, but I've not seen that most times like a case study. So that is another possibility. Another one is fluctuating. Revenue can also be fluctuating. Your gross margin can be fluctuating. Your current ratio can also be fluctuating. I've not also seen that in most of the ICANN case study paper. Fluctuating is, for example, year one to year two, it increased. Year two to year three, it declined. Year three to year four, it increased again. Year four to year five, it declined. So it's fluctuating. Okay. So that's other two possibilities. It's either it is static or it's fluctuating. Okay. Now, but then again, what is common is either is increasing. That means you witness increase year on year, or you witness decline year on year. So the first thing you are saying is what has happened in brackets, increase or decrease. Okay. I hope you have captured that. But let me tell you the simple truth. Everybody can do that. If you have written case study before and you scored, let's say 10 or 15 or 20, or let me say if you score below 30, do you know the problem? The problem is because your analysis were full of what has happened. Because what has happened will only fetch you 1 mark, if not half mark. So how many half marks are you going to get to 50? Or how many 1 mark will you get to get to 50? So by the time you do what has happened, you're always talking about increasing, decreasing, or declining. That's what you're saying. So that was the problem. Number two, that will make you to pass, or that will make your marks to fly and pass 50. Number two. So there are 4. Don't forget. I just told you number 1, what has happened in brackets, increase or decrease. Okay. Number 2, reasons for what has happened. And that's what I call the drivers. In brackets, the drivers. Okay. Reasons for what has happened. Okay. In brackets, the drivers. I hope somebody is helping us to note this. Okay. It's in your section 2 notes. Okay. So you can check it out. But you can also learn it now. Okay. So the first one is what has happened in brackets. Is it increasing or declining or decreasing? And number 2, reasons for the increase or reasons for the decline. Okay, reasons for what has happened. In brackets, the drivers. This is where the bulk of the marks are. Most likely, this might fetch you 3 marks. You can imagine. So if you do one interpretation and you're able to tell the examiner the reason for that increase or the drivers for those increases, that's what they call DuPont analysis, then you can imagine how many 3 do I need to get to 50 as against half mark or 1 mark. Did you see? So now, if I analyze and I realize that my revenue was increasing, you see, why revenue was increasing, the answers are in the case scenario. So when we start checking questions, I'm going to show you. So that's why in the past exams, whenever I can release pristine, okay, I hear a lot of comments. People will say, this pristine is scanty, There is no information, blah, 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 and all of that. I said, oh, really? And when I come on stage and I display the I'm going to do it for you first. I will do the preliminary analysis with you guys, okay? When it comes out, don't worry. And I start analyzing. People screaming, they'll be screaming, wow, the same case scenario. All the answers are in the case scenario. You only have added advantage if you are working, but because you have work experience, or maybe what you do currently requires you to write reports. So you have an added advantage. Okay. So what has happened? Why is revenue increasing? Let me give you some general examples. Why will revenue increase? It could be because we are operating in a monopoly market. One. Number two, it could be because we reduced our price, selling price. Number three could be we introduced more products. Number four could be we are selling top quality products. Number five could be our aggressive market penetration strategy. Hey, these are just general examples. But the real examples, depending on the case we are doing, is in the case scenario. So there's always a reason for those performance. And those are the things that makes you to be a unique professional from other professional. And that is why you're a chartered accountant. So you have to make the numbers talk. You cannot limit your interpretation to what has happened. Your client or your boss that is asking you to carry out this analysis can see what has happened, but they may not know the effects or the reasons behind those figures. That is why they're asking you as a chartered accountant to help them to unveil what do we need to do to sustain this performance or to improve this performance. So it's now less for you to dig down and start looking at those numbers. Why is revenue increasing? Remember, let me tell you something. The fact that revenue is increasing doesn't mean a company is performing. And I'm going to prove it. When you start seeing questions. And the fact that revenue is declining doesn't mean a company is going to collapse or that they are not doing well. And a company can make profits, but they don't have cash. A company can have enough cash, but they are declaring losses. Is it confusing? Okay, it's not confusing. Oh, yeah. Sorry. Okay, I just enjoy this aspect of case study because just at my fingertips. So that's what I'm trying to break it down. I didn't rush into the question. So I needed to lay great foundation so that when we are looking at those questions, it is easier for you. If my profit is declining, why? Go and check admin expenses. It's increasing. Go and check. The answers are there. Go and check your finance costs. Go and check what's it called? Your taxation, your general expenses, your overheads. They are probably increasing. That is why your profit is declining. The answers are there. Why is my gross profit increasing? Go and check your cost of sales. Probably is declining. If your cost of sales is not declining, go and check your revenue. Your revenue is witnessing magnificent or significant increases. So that's why your gross profit is also increased. Okay? So that's the meaning of what was responsible, the reasons for what has happened. If my total asset is increasing or my non-current asset, why? There's a reason. Maybe we are doing revaluation or we are buying additional assets. That's it. So there is always a reason why for all of those ratios that you have computed, why they are increasing. For example, let me pick another examples. My inventory is increasing. Inventory days is increasing. That means it's taking me longer time to sell. It's either I am producing more than I am selling. Did you see that? I'm producing more that I'm selling, or people are not buying. Okay? Or people are not buying. That's it. It's either I'm producing, my rate of production is faster than the rate at which I am selling. So that could be responsible for my inventory days to be increasing. If my receivable days are increasing, why? Simply because my debtors are not paying me as I went due.
Okay, they are not paying as I went due. That's why it's increasing. And if it is declining, that means they are paying as I went due. The same thing with my payables. My payables are increasing. I am not paying my creditors as I went due. Okay, right? Because I have short-term liquidity problem, or I am diverting those short-term source of finance into something else. I just decide not to pay. Okay, so these are there are answers there. And if it is declining, that means I am paying them on time. Okay. So that's what you need to understand. So the answers are always there. So that's the essence of you understanding the drivers, the reasons why those items are either increasing or declining. And that is number two. Remember, all of this will be embedded in your interpretation. So as you are writing, it will be at the back of your mind. Make sure you are not just talking, you're not just writing for writing's sake. In fact, as you are writing, you are happy because you understood what you are writing. You're not just writing, okay? You're not just writing. And let me tell you something here. Don't do some technical mistakes. I call it technical mistakes that people do. For example, if you want to analyze, you now start, you say revenue. You start talking about revenue. Net profit margin, you underline, you start talking about it. Gross profit margin, you underline, you start talking about it. That is dangerous. Okay, go and check it. You cannot write more than 2 or 3 lines. You don't need to do that. Worst case scenario, you can say profitability analysis. Then talk about all the ratios they have calculated under profitability. And if you are very good, if you look at net profit margin and gross profit margin, they have the same trend. Maybe they are declining or they are increasing. Then I can tell the examiner, the review show that despite increases in revenue, both gross profit margin and net profit margin deteriorated over the last 5 years. That's what you're saying. Can you see that word? Deteriorated because they were declining. That's it. So you don't need to be taking them one after. So it helps you to be so articulate. You understand what you are doing. Okay? You understand what you're doing. All right, I have a question here. Can one assume these reasons without getting them from the case scenario? The answer is no. You cannot assume because the problem that is facing company A is not the same problem that is facing company B. So I am just giving you general scenarios. So when we get to those case scenarios, I'm going to show you the specific issues with the case. You know, I mentioned to say all the answers are in the case scenario. I'm able to produce these general reasons because I have seen different financial statements. I have analyzed different financial statements in the last 7 years. Okay. I analyze for my company. I do what I call financial risk analysis, or we call it financial risk assessment, where I look at audited account for the last 3, 4, 5 years. I analyzed it. I'm using the same metrics, and I tell the board where the issues are, and they take it off. Okay, so you can't assume. Okay, so the answers are in the case scenario, but because I'm teaching now, so I'm just giving you wide examples so that you can resonate with that. Okay, so when we have a review question that we're going to look into shortly. So when we get in there, we will now start seeing those answers. Is that okay? And when I get to the real case study again, I can pass exams. We are also going to see all of that. But you need to understand what I'm saying. You need to also have these examples at the back of your mind. In fact, you understanding this example will help you to identify when you see those issues in those case scenarios. Is that okay? For example, I mentioned earlier, I said, if revenue is increasing, you can just think, even you know the answers. Yeah. What do you think can happen? Or what do you think led to a company's revenue to increase? Maybe they reduce their price. Maybe they are operating in a monopoly market. Even if they are not operating in a monopoly market, it could be that they are strategically located. The customer has easy access to them. It could be that they have a great brand name. People already know the brand. There are some people that if they don't see certain brand, they can't buy. For example, some people cannot use any other phone other than Samsung or iPhone. They cannot. Okay. So it could be the brand. Some people just buy because of the brand. They don't even care. Even if they buy the phone today and it gets issued tomorrow, they still go and buy that brand. We don't know. So there are reasons, there are factors that are always responsible for the performance of a company. In fact, choice of accounting policy, that's on the advance, can also be responsible. If you have the same company, the same industry, the same capital structure, the same asset base, the same customer base, the performance can never be the same. Why? Maybe for 2 or 3 reasons. Number one, I call it management quality. Number two, choice of accounting policy. If one company uses cost model, the other one uses the revaluation model. Obviously, the company that uses the revaluation model, especially the revalues upward, will report higher profits. And the third one can be industry trend, okay, or industry specific issues. Okay, all right. So you can't assume the answers are there, okay, but you need to understand these wide examples. Okay, I have told you 2 things. So let me recap. One of them, what has happened? Is it increasing or declining? Two, reasons for what has happened. Reasons for revenue increasing, reasons for revenue declining. The answers are in the case scenario. Remember, I just used revenue. I think I also mentioned gross profit. All right. I mentioned your profitability. Why is it declining? If you want to look at why my admin expenses is declining, go and look at note to the account. You see one nasty item there that is unusually high. So that's the driver. Okay. Then you can hammer on that. Okay. Number 3, business impacts. What is the effect of what has happened on my business? So that's what I call it business impact. Did you see that it is sweet? You're starting from revenue increase by this so percent, blah 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 blah. The reason for increase in revenue might be as a result of you're going to pull it out from the case scenario. So if your revenue is increasing, what's the impact on the business? Yeah, especially if there are cash saves. That means there is sufficient cash to run the operations of the company. If revenue is declining, it's a wake-up call. Okay, so that means it might have devastating effect on the company. Profitability might decline. Okay, the cash might not be available for the company to finance their operations. Did you see? Business impact. If expenses or cost of sales keep rising, what is the business impact? Lower profit margin. Did you see? There's a lower profit margin. And it can lead to going concern if it is material and the company cannot return to profitability. If care is not taken, they will start declaring losses. If you look at the financial statement and the company made loss in the current year, what could be the impact? Negative retained earnings. And it can erode shareholders' value. Did you see? What are the business impacts? The answers are, you see, how do you speak in that manner? And they will ask you to come and write case study. It's not possible. Who is the marker? You don't even know what to know. Did you see that short analysis? The company is declaring losses, and I'm interpreting, and I will tell them if you continue to declare these losses and you cannot return to profitability, obviously it's going to lead to negative return earnings, and it's going to erode your capital. It's to wipe it out. That's it. And before you know it, that means you need to inject more capital. And that's number 4, recommendation. Did you see? I was already saying that you need to inject more capital so that you can return back to profitability or probably to solidify your capital base. So that is it. So number 4 is recommendation, but your recommendation is split into 2. It's divided into 2. The first is sustain. Are you recommending to sustain or are you recommending to improve? Okay, sustain means if revenue is increasing or it is a solid performance, so the recommendation will be to sustain that performance. If your cost is rising, your recommendation will be to improve, because you cannot say they should sustain rising costs. Okay, so it's going to be improve. What can the company do to bring down costs? That is improvement, and that is what your recommendations will look like. So remember, your recommendation will be linked to the driver. What is making my revenue to increase? So I will now factor my recommendation around that number 2. Sustain business strategy, sustain aggressive marketing activities. You can also sustain your pricing strategy. Did you see that? So it's linking, because the issues are down number 2, which are the drivers. That's where the issues are. Okay. So when you are making your recommendation, it should be linked to, you cannot just create a recommendation from nowhere. No, it has to be linked to the issues you have identified in the case scenario. So those are the 4 ways or 4 things that you must capture as you interpret. So the first one, what has happened? Is it increasing or decreasing? Number 2, the reasons for what has happened, which I call the drivers. And number 3, the business impact, the effect of what has happened on my business operations. And number 4 is recommendation, which can be either to sustain or to improve. I hope you are blessed tonight. So we can stop the class, Abby. No, we are not stopping the class. Let's continue. If you have questions for me, you can ask before we go to this um question. I hope you are blessed. Sorry. Okay. Wow. Okay. They help us to write it down. Let me check that. This is nice. Wow, this is great. What has happened? Increase or decrease drivers? Reasons for what has happened, business impact, effects on the business, recommendation to sustain or improve. This is great. This is great. This is great. This is great. Okay, somebody said I should explain more on sustain improvement. Okay, throw more light on impact. I don't have touchlight though. Is that I should throw more light? I don't have touchlight. Sorry, I don't have touch. Touchlight is tautology. Abi. Okay, so let me look at that. So let me look at those questions before we go here. More on sustain improvement. Sustain. Okay, let me try to answer that. I didn't get that clearly. So what I'm saying is, for your recommendation will be linked to the issue you have identified. Okay, so let's say, the first is what happened. So let's say your revenue was increasing. So that's what happened. Then the reason for the increase, you also stated. Remember, I said to be in the case scenario. Okay, so let me assume the reason for the increase can be around pricing strategy, aggressive marketing strategy. It could also be that the company introduced more products into the market. It could also be that they are operating what I call what they call this is a cost leadership, right? That means they have top quality products. Is that okay? Right. Then you talk about business impact. So your recommendation will now be that the company should continue to maintain their pricing strategy and also maintain their aggressive market penetration, and they should not compromise quality. Did you see that? So that's to sustain. But if the revenue was declining, okay, and one of the reasons why revenue was declining is because the company reduced their prices. No, sorry, increase their prices. Okay, sometimes when you increase price, revenue can decline. Not all the time. So that's why I say you can't cram it. You need to be flexible. Okay. So, but then maybe because they increase their prices, okay, people are not buying, or they withdrew some product from the market. Okay, so their product portfolio has reduced. Obviously, it will impact on their revenue, or probably the marketing they are doing is not really effective. Okay, their marketing strategy is not effective, or there is an existence of a highly effective competitor in the market. So, some people can just come with one nasty business model and they will just erode your customer base. Okay, so that's the reason for decline in revenue. So your recommendation will now be to improve. Okay, because revenue is declining, so you make recommendation to improve. If revenue is crazy, you make recommendation to sustain. Okay, so you now start talking about the company will now need to start doing maybe competitor analysis, or they can do SWOT analysis so that they can know their strengths, weakness, threats, and opportunities. Okay, they might need to review their pricing strategies. Did you see that? Okay, they are linked back to those issues, which are my drivers. Okay, they might now start looking at their marketing strategy. Maybe they need to work on that. Okay, so that's how to create your recommendations. I think I've been able to answer that. So somebody is also saying, show more light on the impact. Okay, so the impact is, if my profit is declining, what's the impact on my business? Nobody wants to see his business profit declining. If you're not careful, you will go out of business. It might lead to going concern problems. Okay, so that's the impact. Impact means effects, which can be positive or negative. Okay, so depending on what has happened, it will help you to generate your impact. So if my what's it called, asset base are declining, what happens is either I'm selling those assets or I'm revaluing them downward, maybe they're downward revaluation, or maybe those assets, they have passed their useful life. So obviously they will not be able to generate returns for me. And if care is not taken, I may not have assets, to produce again. Okay, so these are issues. All right. So that's meaning of business impact. Okay. Thank you so very much. Thank you. I think you are good, right? Okay, so let's look at this question. So I'm going to read it from here, and we look at it. So let's see if we can apply what I've just said. Okay, I guess you are ready. So you have it on the group already, so you can open it on your device. You can do that, but you can just stay tuned to your device and listen. Sorry, I don't know why I'm taking so much water this evening. Why? Because I'm using all my strength to talk. And my brain is really on fire because I have to think, to produce, because I didn't really prepare for I don't normally prepare for any class anyway. I'll just appear online and start talking. Okay, so let's see this question. Sorry. Niva is a company that manufactures and retail office products. Their summarized financial statement for the year ended 30th June 2024 is as follows. Okay, so we're giving the financials. So I wanted to use this to demonstrate how to carry out great financial analysis. So we're going to look at broader case scenario from next week that has other information. So for me, I don't believe into going to complex. So let me start from the simplest so that we graduate gradually to the complex. Okay, so that's what I'm doing. So we have revenue, blah, 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 blah. So we're giving the financial statement. So let's see. It now says the directors concluded, look at this. The directors concluded that their revenue for 20X4 fell below budget. So if I were you, if I'm reading this case, this is critical. You will underline it immediately. So they said the revenue for 20X4 fell below budget and introduced measures in the year ended 20X5 to improve the situation. Can you see? So they introduced measures to what? To improve the situation. So what are the measures? Number one, cutting prices. Look at this. Cutting prices. So now look at that. I like this case. Now, they had an issue from the question. What's the issue? When they ended 20X4, they realized that their budget, their revenue fell below budget. You can see they might be having good performance, okay, but they just saw that why is it that we did not make this our revenue target? So they had that issue, Okay, they now have to introduce some measures, probably to manage that issue. And the first thing they did was to cut prices, hoping that if they cut their prices or they slash their prices, they will have more people buying. And number two, they extended credit facilities to customers. You can see they extended credit facilities to customers. Why? So maybe they normally do 30 days before or 20 days. They now extended it so that to attract customers to come and buy. If I'm the one uh, writing this case scenario, what will be coming to my head? Receivables. It might be high. Okay. Receivables can be high because they are extending credit facility. And number three, leasing additional machinery. So because they have reduced their price, so they're also anticipating that they might be producing more. So their existing machines may not be able to accommodate the significant increase they are anticipating in terms of revenue or in terms of production. So that's why they have to list additional machinery. So these are the three major actions that they have taken. They now say the directors are now reviewing the result of 20X5, and I've asked you for advice as external business consultant. Did you see? So they're asking you as a chartered accountant, tell us whether or not the above strategies have been successful. That's what they're asking you to do. Okay, help us. You see now. You see what I'm saying now? They were the one that said their revenue did not meet the budget. They were the one that sat down and came up with 3 strategic actions: cutting of prices, extending credit facilities, and listing additional machinery. They are the one that did it. Now, they now presented this result. Look at this result. Look at this. Revenue here of 1.1 billion here. He said it fell below budget. Can you see? Now, in 20X5, the revenue rose to 1.3 billion. It increased. So why can't they conclude and say, wow, this strategy is actually working, but they don't know what to do. So they have to come to you as a professional. Help us to analyze our account. Okay? Help us to analyze our account. All this strategy, did they actually work? That's what they want you to do. It now say required, prepare a report to the directors of NIVA. Look at that. Assessing the performance and position of the company. Did you see? Assessing the performance and the position of the company. Did you see that? Sometimes the examiner can say, assess the financial health of the company. It's the same. Okay? For the year ended 20X5 compared with previous year. So it said you should assess and compare with previous year. That's why you need to pay attention to requirements in the case scenario. It now said, and advise them. Look at that. And advise them whether you believe their strategies has been or have been successful. Did you see? So these are the key words here. Assess their what's it called? Financial performance. Assess their financial he said assess their performance and position. When it says performance, it's talking about income statement. When it says position, it's talking about statement of financial position. So all you need to do is to select ratios that affect income statement. Select ratios that affect balance sheet. That's all. And you will agree with me that the 10 ratios we have chosen can feature here. That's it. The 10 ratios we have chosen, if you look at gross profit, net profit, it affects the income statement. Remember, you will do your revenue trend, okay? If you look at return on capital employed, it affected both statements. If you look at current ratios and asset tests, that's your financial position. If you look at inventory days, payable days, receivable days, it affected both income statement and the balance sheet. And if you look at your gearing ratios, it affected the position of the company. Did you see? So basically, the examiner is asking you analyze the profitability of the company, analyze liquidity, analyze short-term solvency, and analyze long-term solvency. That's what it's doing, okay? So before I go to the calculation, let me even look at this item line by line. Even without computation, we can interpret, we can know what is happening. Look at revenue. Revenue was 1.1 in 20x4, that is said it fell below budget, but in 20x5, it was 1.3 billion. It actually increased. When I look at cost of sales, it was 753 and it was 1 billion. It was 753 million in 20x4 and it rose to 1 billion in 20x5. Is this a bad performance? The answer is no. It's not a bad performance. Okay, listen to me. Normally, when your revenue is increasing, it is normal for your cost of sales to also increase. And I'll give you an example, okay? Because I have seen reports where when some candidates will start flogging cost of sales. They will say it is too much. Why is it increasing? The only time you can flog cost of sales is this. Probably your revenue, the marginal increase or the proportionate increase in your revenue is not directly proportional to your cost of sales. Then that could be a red flag. Okay, but let me explain this. So let's say I am hosting this class, for example, and this class can only accommodate 100 candidates. Okay, so the license for this Zoom class can accommodate 100 candidates, but I have 200 more candidates that want to join, okay? And they are ready to pay so that they can join this class. So the money they are going to pay is my revenue, okay? So I'm going to get that revenue, but I needed to expand the network, or sorry, the participants. And by doing so, I need to pay Zoom so that they can extend the number of participants that I can accommodate. So for me to get that revenue, I need to pay more. Does that make sense to you? To expand. So automatically my cost, because it has to be a cost to me, is going to increase. And of course, my revenue will also increase. So you cannot expect revenue to be increasing and cost of sales to be declining. It's not possible, okay? Except on rare occasion. Maybe there was a surge in the market because I did, especially for manufacturing, except if it's a service industry, okay? Except if it's a service industry, you can see me cost of sales is relatively stable and it's not really increasing, but revenue is actually increasing. But it's unusual again because because even if it's a service industry, you would have incurred some costs. For example, in a school or tuition center like this, maybe you want to prepare material, because your customer base or student base is increasing, obviously, you're going to spend some money. So don't say because what's it called now? Cost of sales is increasing, a big problem. Okay, all right. So that is that. But again, when you look at it, you now realize that gross profit actually declined. Look at this. Revenue increased, but gross profit declined. Did you see? So you see, I've not even calculated. We are just looking at the figures, raw figures, absolute figures. If I want to interpret this, I can tell the examiner, look at this. I will say, the review showed that revenue increased by, how do I know? I can quickly do trend analysis. How do I do trend? New year minus old year divided by old year. So my new year will be 20x5, okay, minus, that's 1.3 billion, minus 1.1 billion divided by 1.1 billion, because that's the old year. Is that okay? So if you press your calculator, you can get maybe 18% or 19 or 20%. But let me use 20%, okay? I don't want to kill the flow. I have the answers on the slide, but let me use 20%. So it's 20% increase. Okay, so let me now interpret. Remember, I gave you 4 things to do when you're interpreting. So I'll say the review showed that, or the analysis of revenue showed that. You see, okay, actually, oh, thank you, it's 20%. Thank you for that. Okay, so I'll now say the review showed that revenue increased by 20% on last year, or the review showed that revenue increased by 20% between 20x4 and 20x5. Did you see? So what will I now say again? I will now talk about the reason for that increase. The reason for increase in revenue might be as a result of management strategy to cut prices. The answers are there. Can you see? And extending credit facilities to customers. That's it. Did you see? You know, I told you earlier, all the answers are in the case scenario. If you can link that increase with those drivers, you can't write this exam. You cannot. They are there. So I was just giving you wide examples earlier. So you can't talk about monopoly here because it's not in the case scenario. You can't talk about quality because they didn't talk about quality here. You know, I talked about quality. Okay, so the answers are there. The reason for the increase in revenue might be or the revenue increases might be responsible, or cutting of prices might be responsible for revenue increase, and of course, extending credit facilities to customers. Then you can go on and talk about business impact. If revenue continues to increase, it simply means that there will be more funding available to the business or to finance business operations. Now, I can do something. Remember I talked about professional skepticism. You remember? You would have done all your introduction and all. I don't forget. So, because I have taught you all of that, so that's why I'm not going into that. Okay. So I'm going to the main body of the report now. That's what we are dealing with. Okay. So I cannot talk about professional skepticism. Look at this. I will now say whether or not the revenue increase or the performance recorded in revenue was within the budget or not is unknown. They talked about something here. They said, where is it? They said revenue for the year 20x4 fell below budget and the external consultant. So they didn't tell me their budget, which is most likely what you also see in ICANN case scenario. Then I will now say whether the increase in revenue fall below or above budget is unknown. That is what we call professional skepticism. Okay? Somebody is saying my voice is low. Is that cool, God? Are you serious? Okay. And I'm shouting. Now that I'm taking water. Okay. Now, you see, I'm just analyzing. So after that, I'll now go to the next paragraph. I will now say, despite the increase in revenue, gross profit margin declined on last year. What does that mean? It simply means that cutting of prices and extending credit facility has worsened the first level of profitability of the company. That's it. That's it. Did you see the linkages now? When you look at operating expenses, it actually declined, right? Yeah, a bit. Then profit from operations declined. Did you see? So that means both gross profit margin and the profit from operations, which is also your PBIT, declined, even though your top line, your revenue, actually increased. So that means the company strategy improved revenue, but it has worsened the bottom. Your finance cost declined, probably because they have paid some loans, okay? Then when you look at operating expenses, it declined, okay? So maybe they're able to control some of their admin expenses and all of that. Profit before tax also declined, obviously, because what's it called? What's it called? Your admin, what's it called now? Your gross margin already declined. So obviously your profits will decline. Okay, so you can see. So these are the key areas. So the drivers are there. So when you look at taxation, it is normal for tax to decline because the higher your profit, the higher your tax. But at the end of the day, your profit for the period actually declined. Did you see? So profit was declining. Okay. So all the top line and the bottom line, they had bad performances. So that means that strategy did not work. I have not done any calculation mere looking at the figures. When I go to the balance sheet, look at this. Non-current assets increased. Remember they said they leased additional machinery. So if it was a finance lease, or even you don't even need to be a finance lease. Once you are leasing and you are the lessee, so you have right of use assets. So obviously you recognize it as an asset. So that could also explain the reasons why non-current asset is actually increasing. Then of course, again, so the question now is, apart from leasing, do they also buy some non-current assets? So we're not giving additional information, but the knowledge of accounting will help you, to also generate answers in this regard. Okay. So in 20x5, it actually increased, even if it is leases. Okay. So this increase is actually very high, except maybe they revalued the assets. So let's check whether they revalue assets. How do we know? We're going to check revaluation reserve. Can you see? Look at evaluation. See, did you see the link? Evaluation. So they actually revalue the assets. So that's why you're seeing evaluation there. So apart from listing the assets or listing some additional machinery, so revaluation might also be responsible for increase in the value of those assets. So when you look at current assets, look at inventory is increasing. So I've not even done the number of days to see. Look at receivables. Aha. They are extending credit facility. It increased. Then I will convert it into days. Then I have a lot of work to do. I have a lot of stuff to do here. I have a lot of what's it called? Write-up to do. Now look at this. There was no bank balance in 2005. In 20x5, even before the strategy, I have a bank balance. Okay, most likely the liquidity ratio of this company is almost zero. That's the meaning. So where is this cash going to? Then I will check my payables. What happens to payables? Look at this. Payables was increasing. Whoa. So that means we're not paying. Receivables was increasing. We are not getting more money from my debtors. I'm not also paying my payables. Then that would have been responsible for overdraft. Look at that. Look at overdraft here. Yeah, because I have no money. So we have to go for over. You see, the answers are there. Look at the way I just analyzed all of this without, I've not even pressed calculator. There was a time I was lecturing and I said, you can actually do all this interpretation without doing any ratio in the appendix. I didn't know somebody was listening to me. And I told them what they must do if they want to do that. That's how when the result was released, the person just called me. I think two of them. They said, did I know that they did not do one single computation? And they passed case study. They just did what I asked them to do. So what that means is anytime they want to do the interpretation, they will quickly press their calculator so that they can get the percentage increase or decline. Then they continue their explanation and they pass. And I'm not saying you should go and do calculation. So you want to do that, you have to be extremely good. Okay. But you can see what I'm doing already. I didn't even press calculator. Mere looking at the figures, I am already interpreting. I know what's happening. So, in fact, most times you may not even need to talk about it increased by this percent. No, by mere looking at this, I can write. That's exactly what is happening here. So look at the analysis. I did not press calculator. I already seen the link. And that's what you wanted to do, the drivers. Probably because I lecture IFRS anyway. So I can mere looking at financials, I will know whether it was window dressed. If you have attended my CR lecture, I tell you, I'll teach you window dress, but it doesn't mean you should window dress the accounts, creative accounting, earnings management, how you can use provisions to manipulate reported results. So when I see, I know, okay? So that is making the numbers talk. And that's why that's your unique selling point. And that's why you are here. Anyway, I'm writing this exam. I don't need a calculator in this exam. Mere looking at those figures, I'll do great analysis. I hope you are blessed. Okay, so let me now show you what to do. So the first thing you need to do is appendix. So let me go there straight up. So this is how your appendix will look like. Can you see that? So let me teach you. So you see appendix 1. Can you see? Financial statement analysis. Why? You know, I told you that when you want to do financial statement analysis, you have 4 analytical tools. You have trend analysis, if you can remember. You have ratio analysis, common size, and all of that. So if you are doing combination of any 2 of those 4, so that means you want to do ratios, you want to do trend at the same time. So you call it financial statement analysis, appendix 1. But if you want to separate your trend from your ratio, so that means appendix 1 will be trend analysis because we want to do trend alone. Then appendix 2 will be ratio analysis. Let me take it again. If you want to do combination of any 2, maybe you want to do trend and ratio, common size and ratio, under one appendix, you call it financial statement analysis. But if you want to separate it, you will call it their names. Appendix 1, trend analysis. Appendix 2, ratio analysis. Is that okay? Okay. So, but here, because I'm combining trend, I'm only doing revenue trend, and I will do ratios. So that's why I call it financial statement analysis. How do you do your numbering? So because I'm under appendix 1, so the first item, there's revenue trend. So it will be appendix 1, that's 1.1. So because I'm doing revenue trend, so it will be 0.1. So old minus, I actually use old here. It's the same anyway. Old minus new divided by old, or new minus old is the same. Just make sure you divide by old. So if you do 1.1 minus 1.3, obviously it will give you a negative sign because I'm using old minus new, okay? But you ignore it, okay? Negative there is just simply telling you that there was an increase, okay? Because I'm taking the old against the new. But if you have said new minus old, it won't give a negative sign, okay? So that was 20%. Then when I come here, I'm still under appendix 1. That's why you see I have 1 here. But I'm doing second item. So that's why you have 1.2 profitability ratios. So under profitability, we said we should do 2 ratios. So under that, you now have 1.2. So that's 1.2 signifying that you're under profitability ratios and you're calculating the first item, which is 1. So that's why you have 1.1 net profit margin. So this is exactly the way we are going to present it. Remember, this is just for 2 years. So if you have 3, 4, 5 years, you just place it like that. Okay. So now you can do, I just followed the way this financial statement was presented, 20x4, 20x5. But the commonest is the current year. You can do 20x5, 20x4, 20x3, 20x2. Is that okay? So you can turn it around to start from the most earliest or the current year. Okay. So, but whichever the case, you are fine. Okay. So I am doing gross profit margin. I'm still under 1.2, but the second item. So that's why you have 1.2.2. Then I'm doing the third item, 1.2.3. Now, 1.3, because I'm doing the third item under appendix 1. So the same thing, we go to appendix 2. You will say 2.1, 2.2, 2.3, 2.4. Okay. So I did current ratio here, then receivable days, payable days, and long-term solvency. So this is exactly what you will now go and interpret, which I have already done, even without seeing these numbers. But when I look at this number, I can see that revenue increased by 20%. I can see that in 20x4, when there was no strategy, my net profit margin was 20.3, but in 20x5 decline. We've seen the figures already, okay? Gross profit was 35%, but it declined. Can you see? Then your return on capital employed was 48. It declined to 29. Oh my God. Can you see? So the strategy actually increased revenue, but it has worsened the profitability position of the company. The same thing, short-term solvency. It was 1.62, although it's still okay if you want to look at that, but it's also declined 1.23. Okay. Hey, look at receivable days. Because we extended credit facility, it jumped from 65 days to 110 days. This is serious. Look at payables. Crying out. 87 days to 120 days. Wow, this is massive. Although their gearing ratio declined, that means they might have paid some of their ratio. That's why you saw finance costs also declining. Did you see? Okay, so I will now come to my report. So it's an attachment to my report. Okay, so you will do your introduction. Let me see. Okay, so we are going to start with, okay, so this is your cover page. Okay, this is your cover page because our external report, and I've taught you this. Then you come to your executive summary. I've not taught you executive summary, so I'll disregard that. After I've lectured the executive summary, I'll come back to this. Okay, so this is a complete report, right? Then, so I will leave space for my executive summary. I will now come to my introduction. So your introduction, I already told you what to do. So look at this: performance, profitability. Start reading. This is what you are doing. I am pleading. You have the report already, even before seeing the percent. Look at this. The revenue of the entity has increased by 20% on last year. That is what has happened. It would therefore appear that the strategy of cutting prices and extending credit facilities has attracted customers and generated increase in revenue. Hey, whether or not the revenue is now below or above budget as of the director's aim is unknown. I didn't know. Despite this increase, however, the profitability of the company has worsened, with both gross profit and operating profit being lower than previous year. Similarly, I told you about paragraph linkers. Can you see? I told you was it last week or 2 weeks ago? Paragraph linkers, go and learn them. Similarly, the operating profit margin declined from 20.3% to 12.9%. There are likely to be several reasons behind this deterioration. Look at that, deterioration. The reduction in price of goods would have contributed to worsening gross profits. To rectify this, that is the recommendation. Levi might consider approaching their suppliers for some bulk buying discounts on the basis that since they are selling more items, they will be able to purchase more material from suppliers. That's what we are saying. Let me come to liquidity because of time. Look at this again. So there was a poor performance under profitability, and that trend continued under liquidity. Again, the company results are showing worsening position in this area. Here, you look at the way I systematically talked about what has happened. Look at it. I didn't even say the review showed that the current ratio, look at the way I started. The company's results are showing a worsening position in this area, with current ratio declining from 1.62 to 1.23. This cause for this will seem to be extension of credit facilities to customers. Receivable days have increased from an appropriate level of 5 days to 110 days. Although, look at this, although the benefit of this strategy has been shown in increase in revenue, it will seem that Niva has been allowing customers too much credit. It's recommended that receivable days should be reduced closer to 90 days. That's the recommendation inside my report. Did you see? I talked about the benefit. That's why it is case study. Okay? As a result of the increase in receivables, Nival has been taking longer to pay suppliers. Did you see? Their payables are now at an unacceptable high level of 120 days. 120 days. Look at this. There's something they call professional judgment. When you are writing case study, sometimes it's like an hammer. You are placing on management decision, unacceptable high level. That's professional judgment. Okay, you are going to write as a professional. This is not WAEC, it's not NECO, it's not JAM. It is a professional exam. So you need to start or is it recalibrating or start training your mind and your brain. You are writing as a professional. You're not just going there just to sit for 4 hours, just want to write anything, expecting to pass. No, give them what to think about. When they read your report, they can't resist. They cannot. How can you write in this manner and somebody will ask you to come and write this report or this exam? It is not possible. Even what you are writing, they are learning from it. Look at this. Look at the implication. This is likely to be causing dissatisfaction with suppliers and will reduce the ability of NIVAL to be able to negotiate discounts. You know, we've already recommended that they should negotiate discounts. Look at this. Come on. I'm done. I have one thing for you here. Red flags to watch out for in the balance sheet, in the income statement, and others. So this is my takeaway for you. Start learning. I commit you into the hands of God. You will not repeat this paper. So you have to start opening your mindset and start believing that you can go into that exam and pull down the stronghold of Jericho. Thank you for listening to me. I believe you are blessed. I'll see you next week. If you have questions for me, you can drop it before we go. Come on. If you have question for me, once 60 seconds, you can put it on the screen. So next week, by God's grace, we are looking at ICANN scenario, where we now have an expanded scope, around how to tackle case study. Okay, so please be prepared. How do we apply leftover right here? Leftover right is about your formula in ratio, so it doesn't come into your reporting. So it's just for your formulas. Okay. Explain linking with the appendix. Okay, so when you are writing your report, you can decide to link with the appendix, but I don't like doing that because my appendix numbering may be different from your own. Okay, for example, if you say revenue increased by 20%, like you see, you can say in brackets, see appendix 1. Is that okay? So you can do that if you want to link it with your appendix, that's fine. But I don't like doing that in my report because my report will normally go viral and my own appendix might differ from my own appendix. So that's why I don't do it. So if you don't link your appendix with your report with the appendix, nobody will penalize you for that. And if you want to reference it, it's also good. Is that okay? All right. Okay, sir, please, what are these red flags exactly? It's just to further tell you, areas to look out for when you're analyzing financial performance of the company. Now, look at the balance sheet. Too much goodwill, rising days in receivables. Did you not see it now? Inventory rising faster than profits. Hey, these are deep analysis. Excessive borrowing. If a company is highly geared, rising loans to related parties. Too much cash line in current accounts. So these are things you might look out for. And in your income statement, you're looking for revenue rising at a slower pace than profits, capitalizing research and development, frequent or large extraordinary changes, sharp decline in taxes. So it's just also a point. I know I was giving some wide examples earlier. So these are also wide examples. So it will also help you to know the areas to look out for when you're analyzing financial statement. What do you mean right over left? We did that last week. I think you might need to listen to that lecture. It's just a way of remembering your formula. It's not right over left. It's just left. What is on the left over what is on the right. So that was last lecture last week. So you might want to listen to that video so that you can get that information. Okay, thank you very much. Thank you for your time. So you can ask me for that question by calling or sending a private message on WhatsApp. So I'll be willing to answer. Have a great evening and then see you next week by God's grace. Take care. Good night.